Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Candlestick Patterns, a complete guide for traders in 2025. Spinning top. The spinning top is another candlestick that signals indecision in the market. It features a small body placed between relatively equal-sized upper and lower wicks. This pattern shows that the market is wrestling between buyers and sellers, with neither side gaining a decisive advantage. Spinning tops often appear during periods of low volatility or after a strong trend. They can indicate a pause in the market, potentially leading to a reversal or consolidation. However, by themselves, these patterns don't necessarily predict the next move. Their real significance emerges when combined with other indicators or analysis tools. For example, if a spinning top occurs at a major support or resistance level, it may hint at upcoming volatility or trend exhaustion. Keep an eye on the next candlestick for clues. Marubozu. The Marubozu candlestick is the polar opposite of indecision. It represents strong, definitive market sentiment. This pattern has no wicks, meaning the open and close prices align with the high and low of the session. There are two types of Marubozu candlesticks. Bullish Marubozu. The candle opens at its low and closes at its high, showing that buyers controlled the entire session. When this pattern forms, it often signals strong bullish momentum and the continuation of an uptrend. Bearish Marubozu. Opens at its high and closes at its low, indicating that sellers were in complete control. This pattern typically suggests the continuation of a downtrend or growing bearish pressure. The Marubozu is a powerful indicator of market strength, and its significance increases when it appears at the start of a new trend or after a breakout. Use this pattern to confirm a trend's intensity or as a signal to enter or exit trades. Understanding these single candlestick patterns can provide a solid foundation for analyzing price action. They're simple yet effective tools for recognizing shifts in sentiment and positioning yourself for potential market moves. Popular double candlestick patterns. Double candlestick patterns provide deeper insights into price action by showing how two consecutive candles interact. These patterns often signal pivotal moments in market sentiment, helping traders anticipate reversals or continuations. Let's break down some of the most widely recognized double candlestick patterns. Bullish and bearish engulfing. Explain the structure and significance of engulfing patterns. Engulfing patterns are powerful indicators that often mark a shift in market momentum. They occur when the body of a candlestick completely engulfs the body of the previous one, indicating a strong change in sentiment. These patterns can be bullish or bearish, depending on their context and direction. Bullish engulfing. A bullish engulfing pattern appears after a downtrend. The first candle is bearish, signaling the continuation of selling pressure. Then, a larger bullish candle follows, fully engulfing the previous one. This shows that buyers have taken control, often predicting an upward reversal. Key features of a bullish engulfing pattern. The second candle closes higher than the first candle's open. Works best when it appears at support levels or after a prolonged downtrend. Think of it as an outright takeover. Bears get overpowered by bulls within 2 sessions. It's a confidence booster for traders looking for a trend reversal. Bearish engulfing. As the opposite of a bullish engulfing pattern, a bearish engulfing candle signals that sellers are gaining the upper hand. It typically forms after an uptrend, with a bullish candle followed by a larger bearish candle. Key features of a bearish engulfing pattern. The second candle closes lower than the first candle's open. Frequently appears at resistance levels or after an extended uptrend. This pattern reflects a shift in sentiment, with sellers forcing prices lower and setting the stage for a possible downtrend. Engulfing patterns are most effective when combined with other factors like support, resistance zones, or confirmation from additional candles. Keep an eye on volume 2. A strong volume spike can make the signal even more reliable. Harami patterns. Discuss bullish and bearish harami patterns, with emphasis on their market implications. The term harami comes from the Japanese word for pregnant, as this pattern visually resembles a small candlestick, baby, nestled within the body of a larger one, mother. Harami patterns indicate potential indecision in the market and can be bullish or bearish based on the trend and structure. Bullish harami. A bullish harami occurs during a downtrend, signaling that selling pressure may be waning. The first candle is bearish and sizable, while the second candle is smaller and bullish, closing within the range of the first. This pattern suggests hesitation among sellers and hints at a possible reversal upward. What traders should watch for? The second candle should not exceed the first candle's range. Appears more impactful near support levels or after extended downward moves. Picture the smaller bullish candle as a spark of optimism in a previously bearish market. It's not a guarantee, but it's often the first sign of recovery. Bearish harami. This pattern shows up during an uptrend. The first candle is a strong bullish one, while the second is a smaller bearish candle that closes within the range of the first. This signals hesitation among buyers and hints at a possible reversal to the downside. How to interpret a bearish harami? The second candle's body should remain tucked inside the first. More reliable if it's located near resistance or after a sharp rally. In essence, a bearish harami acts like a red flag for bulls, hinting that the upward momentum might be losing steam. While harami patterns aren't as dramatic as engulfing patterns, they often serve as early indicators of potential trend changes. Confirmation through subsequent candles or additional tools like trend lines can strengthen their reliability. Tweezer tops and bottoms. Describe how tweezer patterns signify market reversals. Tweezer patterns are symmetrical formations that stand out because of their nearly identical highs or lows over two consecutive candles. These patterns are great at signaling reversals and can be either tweezer tops or tweezer bottoms, depending on their placement in a trend. Tweezer tops. Tweezer tops appear after an uptrend and are a sign that the bullish momentum may be fading. The first candle is bullish, with a high point that the second candle matches. However, the second candle is bearish, closing lower. This indicates that sellers are stepping in, potentially reversing the trend. Recognizing a tweezer top. Both candles have nearly identical highs, creating a visual double top. Commonly appears near resistance levels or following extended rallies. Think of it like a ceiling. Once the price hits it twice, it signals exhaustion, paving the way for a potential downturn. Tweezer bottoms. This pattern occurs during a downtrend when two consecutive candles form similar lows. The first candle is bearish, showing continued selling pressure, while the second candle is bullish, signaling that buyers are stepping in. This often points to a reversal upward. Key characteristics of a tweezer bottom. Both candles share nearly the same low point, forming a visual double bottom. More effective when found near significant support levels. Tweezer bottoms work like a sturdy floor, preventing the price from falling further and signaling a possible bounce back. Tweezer patterns are most accurate when supported by volume spikes or other reversal signals, such as RSI divergences or MACD crossovers. While these patterns are simple to identify, always consider their broader context within the trend for stronger predictions. Double candlestick patterns like these offer powerful insights into potential market shifts. By understanding their structures and implications, you can make informed decisions and act with confidence. They exemplify how just two candlesticks can paint a vivid picture of changing sentiment. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.